Hey, this is Mark from Caliber Home Loans with another episode of Mortgage Tips from the Trenches. So today we're going to talk about Michigan property taxes. So a lot of home buyers get very confused as to why their taxes go up once they purchase their house and the city or the township has reassessed. So I'm going to walk you through how that works in Michigan with current law. So in Michigan, there's two valuations in a piece of property. There's the state equalized value, which is basically what the city or township considers your cash value, and there's a taxable value. Property taxes are based on the local millage rate and apply to the taxable value. Some cities and townships have different rates based on what school districts the property is in. So for instance, if the city or township has multiple school districts, depending on what school district you're in, what the property is in, you'll have a different tax base. So your taxes will be different even though you're in the same city. So let's look at the state equalized value. So this value is initially based on half of the sale price or the cash value, or some percentage of the sale price. If it's not 100%, it's usually pretty close, maybe 95% of what you purchased the home for. Any annual increase or decrease is based on the percent change in the municipality where the property is located and not on the actual parcel. So they don't look at each individual house every year and say, okay, your house went up by 3,000, your house went up by 5,000. So it's based on the township or the city where the house is. They take an average and they look at an average increase, percentage increase or decrease. So the taxable value, this value is initially also based on half of the sale price or cash value, or some percentage of the sale price. They use the same math as the SEV. Unlike the SEV, the state equalized value, future increases in the taxable value of individual parcels of property is limited to the lesser of inflation rate or 5%. So the increase is capped. It can't go up as much. So let's say your house went up 10% in 1 year. Worst case is that the taxable value will only go 5%. Now, typically in Michigan, the last number of years, our inflation rate's been pretty low, or nationally it's been pretty low, so you're not seeing taxable values go up very much year to year. Now, the increase is capped, but there's no there's no cap on the decrease. So if property values fall, there's no cap on how far your taxable value can fall. So when a property is sold or transferred, the taxable value is reset to equal the state equalized value, which equals half of the property's cash value, also referred to the uncapping of the taxable value. So this is important. So again, when you buy a house, at some point the city is, within the year, the city or the municipality is going to reassess your house based on the purchase price, what you purchased the house for. So one other thing about property taxes in Michigan is there's homestead versus non-homestead taxes. So when a home is used as a primary residence and you live there, the homestead millage rates will apply, and these are the lower of the millage rates. If the house is not a primary, if it's a second house, vacation house, or a rental property, non-homestead millage rates will apply, and they tend to be higher. So there's a gap between homestead and non-homestead. Now this also varies city to city. Some cities, the gap is small based on elections and the residents wanting to maintain a certain level of school taxes. In some cities, the gap is larger. It just depends on where the property is located. So what does this really mean for a buyer? So let's take a look at what actually happens. So let's say that you're buying a house and you're looking at a home, and the current owner bought that house for $200,000 in 2012. So once the city reassessed, the initial SEV, which is state equalized value, the cash value, and the initial taxable value were set at $100,000. So fast forward to today, and you're looking at purchasing the home for $320,000. So let's say that the SEV went up to $150,000. Now it could be less than that. Oftentimes, what we buy a house for, the current SEV is less than what we're buying the house for, because the true market value is usually greater than what the city has you pegged at. And let's say that over that time from 2012 to 2020, the taxable value only went up to $130,000. So the current owner is getting a break. Their taxes aren't going up as much as they should be based on the actual increase in value, or what the city thinks that the house is going up at. So once you've closed, you bought that house for $320, and once you've closed and the city reassesses the house, they're going to set your SEV at $160, which is half of the $320. Now they're going to raise your taxable value to $160. So you're going to get a bump in your property taxes. Your property taxes are now based on $160 instead of $130,000. So the issue with this is the longer that the current seller has lived in the home, the wider this gap, the bigger the jump from where they are in taxable value to where you're going to be once they reassess. And the reason for that is they've been capped for all those years. The house has been going up in value 3, 4, 5, 6% a year, but the taxable value has not kept up. So their taxable value actually can be quite a bit lower. And then once you buy it and it gets reassessed, your taxable value will jump. So I just want to make sure that you understand that that's going to happen. So tips, how to get in front of this. I'm a big believer that you need to know what's ahead of you. So before putting in your purchase offer, you should call the city or township, the treasurer department, to determine what your future property taxes will look like. Give them the address. They'll be able to tell you based on current millage rates what your annual taxes should look like. Then again, before putting your offer in, call your loan officer and have him or her run the numbers so that you know what your payment, cash investment, and also future payment will look like. It's really important that you understand what your out-of-pocket is going to be for closing, what that payment's going to look like, and how potential uncapping of those property taxes are going to look like in the future. And then the third tip is to always ask your loan officer what we call a total cost analysis. This is a multi-page report that will determine what your options may work, what options may work best for you. So in the total cost analysis, we can look at different houses, look at what the different purchase prices, what the different taxes, different down payments are all going to look like as far as your out-of-pocket investment and your monthly payment. So that's how Michigan property taxes work. So any questions, give me a call, 248-705-8431. All my information is on the slide, and I can actually walk you through this, and there's some great websites also that I can send out to you to help you maneuver through this. Thanks a lot and have a great day.